Hello, and welcome to Credit Compass, your guide to navigating European credit markets. Despite headlines suggesting the conflict is essentially over, bombing continues and it remains difficult to determine how long the situation will last. However, the fact that the U.S. administration appears to have responded to market pressure suggests tensions may ease and that oil flows through the Strait of Hormuz should resume. While these developments have dominated market attention, there have also been several important shifts beneath the surface, which we will also explore today. All right, let's dig in. Last week, we covered the basics of how the Iran conflict could affect European markets. This week, we'll go a little bit deeper. Let's start with oil. Oil prices have been volatile. Prices moved from just over $100 a barrel on Monday to roughly $90 on Tuesday, after trading around $70 as recently as February 27th. On Monday night, G7 nations suggested that strategic reserves could be released if elevated prices persist in order to support supply. At the same time, the U.S. administration indicated that the conflict might be nearing completion after claiming significant damage to Iranian military capabilities. Now, while oil remains important to the European economy, its impact has declined over the past 2 decades as the region has gradually transitioned towards renewable energy. That said, oil and petroleum products are the largest single component of energy imports, accounting for roughly 37% of final energy consumption in 2024. Some countries are particularly exposed to oil price movements. Smaller economies such as Cyprus, Greece, Luxembourg, Malta, and Ireland derive more than 50% of their energy consumption from oil and petroleum products. Spain also remains heavily reliant, with oil accounting for roughly 48% of energy consumption. The shift toward renewables has helped reduce the sensitivity of inflation and economic growth to oil price shocks. However, sustained increases in oil prices would still affect the economy by raising production costs and eventually pushing up consumer prices. The key word here is sustained. It takes time for higher input costs to pass through the production chain. That said, given recent experience during the Russia-Ukraine energy shock, businesses may now be more sensitive to raising prices earlier in the process. The bigger energy story for Europe, though, is natural gas. Following the shutdown of Russian pipelines, Europe has become more reliant on liquefied natural gas, or LNG, particularly from the Middle East and the U.S. Natural gas represents about 20% of Europe's energy consumption, but its economic impact is significant, especially for industrial sectors. The Dutch DTF benchmark, Europe's key natural gas price indicator, rose from roughly €32 to €70 at its peak, before retreating to about 48 on Tuesday. Even at that level, prices remain well above pre-Russia-Ukraine conflict levels, when natural gas typically traded between 15 and 20. The countries most dependent on natural gas include the Netherlands, Belgium, Italy, Hungary, and Germany, which means these economies are particularly exposed to potential disruptions. Natural gas accounts for roughly 25 to 30% of final consumption across these economies. If we combine oil and natural gas, these two sources account for roughly 57% of Europe's final energy consumption, despite the growth of renewable energy. Several countries have particularly high combined exposure: Luxembourg, Belgium, Ireland, Italy, Spain, the Netherlands, Romania, Greece, Croatia, and Hungary all derive 60% or more of their energy consumption from oil and natural gas combined. A sustained level of high prices could have significant economic impact on these countries. Let's take one step further down the chain to fertilizer. Fertilizer production is extremely energy intensive, which is why much of it takes place in the regions where energy is cheaper, including parts of the Middle East. Europe is not overly dependent on fertilizer production, specifically from Iran or countries directly reliant upon the Strait of Hormuz. However, disruptions in the region can still raise global fertilizer prices, which ultimately affects European agriculture and inflation. Countries with significant fertilizer imports tied to Middle Eastern production include France, Spain, Italy, the Netherlands, and Belgium. So what does all this mean? Europe remains structurally dependent upon imported energy, which means rising global energy prices can still affect both growth and inflation. That's why we've begun hearing renewed discussion amongst market participants around the possibility of a stagflationary environment. Europe was arguably just beginning to emerge from a mild stagflationary period, and a prolonged energy shock could push the region back in that direction. The market relief we saw on Tuesday is encouraging, but whether it holds will largely depend on how the conflict evolves and whether energy supply disruptions persist. For now, the uncertainty premium related to the conflict will likely remain embedded in both energy markets and the broader capital markets. Now let's turn to recent economic data out of Europe, particularly Germany, where the key question is whether the long-anticipated economic transition can gain some traction. The latest data presents something of a mixed picture. February PMI data suggests expansion, with manufacturing, services, and the composite index all showing improvement relative to prior readings and showing expansionary readings. However, construction continues to lag, reflecting persistent weakness in the sector. Meanwhile, the strong factory orders we saw in December declined in January. Orders remain positive year over year, but the increase was much smaller than expected and represented a significant pullback from December's levels. Industrial production also remains weak, falling 1.2% year over year in February, underscoring the ongoing challenges facing Germany's industrial base. So what does this mean for Europe more broadly? Well, the expected growth turnaround is happening, but more slowly than anticipated. Last month's upside surprises have moderated, and the transition towards stronger growth appears likely to take longer than many expected. Part of the reason for that is the anticipated fiscal spending from the German government has been slower to materialize. At the same time, rising energy costs could offset some of the progress by increasing uncertainty and maintaining relatively high energy costs for German industry. So what are the markets telling us? Well, as the conflict unfolded, interest rates initially rose, reflecting concerns about both higher inflation and weaker growth. In other words, the market began to worry about stagflation. Ironically, just before the conflict, the euro area had begun to undershoot inflation, raising concerns that the ECB might need to cut rates further. How quickly things change. Suddenly, markets began pricing in the possibility of rate increases instead of cuts. That view has since moderated somewhat, but the balance of risks has shifted towards rates staying higher rather than falling sharply. Let's look at 5-year rates, which are particularly relevant for corporate financing and forward market expectations. In the euro area, the 5-year rate is about 5 basis points higher than at the start of the year. As of Tuesday, March 10th, at one point it rose about 30 basis points from February 27th, the day before the conflict began. In sterling markets, the UK 5-year benchmark is roughly 20 basis points higher than year to date and had risen nearly 50 basis points since February 27th before retracing slightly on Tuesday. Turning to credit spreads, the conflict has pushed spreads somewhat wider. However, relative to the start of the year, the move has been modest. The Pan-European Aggregate Index is wider by only about 4 basis points year to date. The high-yield index, however, is roughly 50 basis points wider, reflecting the fact that more highly levered issuers are typically more sensitive to volatility. Meanwhile, the iTraxx crossover index widened by about 30 basis points from February 27th through Monday, before recovering roughly half that move on Tuesday. So what does that tell us? Before the Iran conflict, markets were already beginning to focus on credit cycle risks, including concerns about AI-driven disruption and rising default risk in private credit markets. Now we can add energy price volatility to the list. The key question is whether we are approaching a turning point in the credit cycle. For now, energy prices have not remained elevated long enough to meaningfully derail Europe's growth outlook. However, they do raise uncertainty, which tends to increase risk premiums in credit markets. Our expectation is that the issuance window will reopen, if it hasn't already, and markets should gradually normalize as volatility subsides. However, only 2 and a bit months into the year, and we shouldn't be too surprised if next week brings us something new again. That's all for this week's edition of the Credit Compass. If you found today's discussion insightful, please follow, rate, and share the show. It helps others to discover it. For deeper insights and data-driven analysis on macro and credit trends, please visit kbra.com/macrocredit. Till next time, stay curious, stay informed, and stay resilient. Let Credit Compass help guide your way.